Nice to be here. Thank you for having me. What I'm going to talk a little about today is about the macroeconomic context for in making investment decisions today. One of the things we do at Silver Lake is we spend our time on microeconomics, understanding the companies, their markets, their products, their competitors, their cost positions, et cetera, and try to know everything. We're dedicated to the proposition, since we're a specialist firm. We're dedicated to the proposition that knowing what's knowable on a microeconomic basis about every company you invest in is really, really important. But we all learned in the financial crisis that you can make the best company selection, but if you do it at the wrong time, you can still get killed or still struggle mightily with your investments. And so it's very important, I think, in addition to doing good investment analysis about individual investment opportunities, to also think more broadly about the macroeconomic context in which you're making investments. And so so that's what I want to talk to you just about a little bit today. The first thing to recognize is, you can see, if I go back to the beginning of this, I have titled this presentation, "The Future is Now, the Recovery Reaches Middle Age." I'll explain to you kind of what that means in a minute, but we have been roughly 4 years into this recovery. I'll show you some data. The average recovery post-World War II is not much more than 7 or 8 years. This is the recovery, right? This is what we're going to get. And the result of that is a lot of things that we thought we should postpone until the recovery got underway. Well, here it is. Like the things you postponed until you're an adult. I'll do that when I get to be an adult. Well, you're middle-aged now. The recovery is middle-aged. It's time to do some of the things that we thought we'd postpone for the future. So let's understand kind of what that means. First of all, it's pretty clear that this, I think you could assert that this is potentially the worst economic recovery since World War II. Right? Usually what happens, we have a very steep drop in economic output, overall economic output, or under any underlying measure. You end up with a very steep bounce back. So you can see on the left here, these are the three worst, these are the recoveries from the three worst economic calamities since World War II, or actually preceding World War II, since in the modern era. So the 3 years following the Great Depression averaged about 10% economic growth, enormous snapback. The 3 years following the 1980s recession averaged about, I forget what that number is, but 5 to 6% growth. You can see in the yellow, and so far we've averaged 2%. You can see a little up here the little dialogue I put up here, which is also what's happening is things have generally been slowing down. So the average growth rate during recoveries since World War II has been 3.4%. Since the 70s, it's been 3%. In this recession, it's 2%. So there's a slowing down, which we can talk about a little bit. But this is pretty clearly the worst economic recovery in history. If you go underneath the covers of this, you also see that its anatomy is something quite different than what we've experienced in the past. All the measures that of business success or business prospects are quite strong. Business investment, stock prices, earnings, all those sorts of margins, everything you look at, the big measures of business operation are very strong, and all the measures of household performance are some of the weakest we've ever seen. Incomes, unemployment, housing prices, et cetera. So what you've really got is an economic performance that is deeply impeded. There was a huge drag coming from the household sector. Since consumer spending is 70% of our GDP and housing is the largest asset class we have other than treasuries, that drag means that overall economic performance is dragged down considerably by the poor performance of the household sector. Obviously, it's no surprise because the housing bust was the locus of the problem. And someone said something interesting, Dave. An economist who was on all things CNBC this morning said something unusually thoughtful for morning television, which was, he said, we've gotten unemployment levels to, we had full employment at 4 to 5% in the last two economic recoveries, but one was the dot-com boom and the other was the housing bubble. And so do we need to inflate a bubble to get full employment down? to levels that will look more like 4 to 5% rather than what we have today. I thought it was an interesting and provocative question to which I don't have an answer. But so if you look at the underlying performance of the economy, it's been averaging about 2% growth. It's one of the worst economic recoveries we've seen, and that has been caused by enormous wounds in the household sector around housing and unemployment that have manifested themselves in consumption. And since consumption is 70% of GDP, that has impeded our recovery. On average, after a recession, consumption increases about 6 to 7% per quarter for a couple of quarters. 70% of GDP, that gives you a big kick. So far, consumption's averaged about 2% growth, 70% of GDP. The 4% missing is a meaningful lag. You know, the 6 minus 2. The 4% missing has created a significant lag. This is the point I made earlier. These are all the periods of recovery since World War II. The average has been 59 months. We're 45 months into this recovery. Now, we had a very long one in the 90s time period that was abetted by this enormous dot-com boom, which all of us fondly remember, except of course, for the part about the ending of it. So it's entirely possible that we are, on average, this is a recovery that's at least middle age, if not kind of in its waiting period. Now, it's possible that since we haven't overshot today the way we had during the dot-com bubble, the real estate bubble, that you could have a slower, longer recovery. But still, we're about halfway through the longest recovery we've seen since World War II. So we have to understand that this is kind of, the future is now. This is kind of what we get. Why is that? Why is it a slow recovery, low levels of economic performance? Largely because I think of this. This is total credit market debt outstanding in the United States as a percent of GDP. And we got, at the end of the housing bubble in third quarter of 2007, to 350% of GDP outstanding in our economy. That's not a level we had not seen since the Great Depression. Now, by the way, we weren't really at that level during the Great Depression, because what happened was a denominator effect. Debt got to about 200% of GDP. Then the economy collapsed, causing debt as a percent of GDP to spike, but not because of an increase in debt. And that was an effect that occurred at the depth of economic distress. But anyway, post-World War II, we got the economy, leveled down, the debt leveled down to about 125% of GDP, proceeded along that way until 1980. And then in 1980 began a 30-year process of levering up our economy, reaching in third quarter of 2007, 350% of GDP at the peak of economic performance. This is a very different time period. So the 300% of GDP was reached at the depth of economic performance during the Great Depression as a result of the economy collapsing. The next peak in American history was reached at the peak of economic performance as a result of actual debt taken on people's balance sheet. Much of the decline since then in private sector debt has been from defaults, by the way. And of course, the government has continued to add on massive amounts of debt. I was looking at the numbers recently, and in the last 4 years, we've doubled the size of the debt, which means we've created as much debt at the government level in the last 4 years as we did in the 200 years that preceded that, which is kind of interesting. And so if you look at this chart, what it tells you is, and this is the question, the issue is the future is now. People look back at the last 30 years, those of us who've been around, who are now entering like me, some of us here are dotage, been in business for 30 or so years, look back over those 30 years, and we use that time period of which to make judgments about how markets and the economy are going to operate, because that's our experience set. Right? You could argue that 30 years was very, very unusual and is not an experience set with which to make decisions, because we had a one-time increase in debt, which is not sustainable. We used that to throw a very, very big party, to buy all sorts of assets on leverage, financial assets, housing assets, credit card debt, student loans, all these different kind of things, educations we bought on leverage, et cetera, and generate a sort of economic performance that that might not be sustainable in the absence of an ability to take that much debt on again. What does that tell you about sustainable levels of unemployment, sustainable levels of economic growth, et cetera, competitiveness of the American economy, et cetera, et cetera? This could have been a very, very unusual period that is not generalizable. But what happens, it also turns out, I'm sure a lot of you folks in here are parents, and just like raising teenagers, where they go through all sorts of experiences that they think are unique, that their parents can't possibly understand because they don't know what it's like to be a teenager. And the fact that most of these kids are pretty smart and they realize that we were teenagers at one point too. But anyway, it turns out that what America has gone through with the leveraging, having the biggest economy in the world, having the reserve currency, inflating an asset bubble associated as a result of taking on an increasing amount of debts, having the asset levels get to unsustainable levels and collapse, but the debt stay around because it's a fixed claim. That is sort of a thing that over the course of somewhere between 500 and 700 years of economic history has been repeated over and over and over again by the world's dominant power. And it turns out there's actually a lot of data to look at, which I haven't done, but some friends of mine have done, to see what happens to economies that go through that over 700 years of financial history. And what you see, it's hard to see up here, but what you see on the upper chart is that if your economy grew 3% in the decade pre-crisis, for all these historical economies in this data set, your economy grows 2% in the decade post-crisis. And if you had a full employment of about 3% in the decade post-crisis, you have full employment of about 8% in the decade post-crisis. And that's been repeated over and over and over again by societies that got at a very similar fix than we did. Inflated an asset bubble, had it collapse, had a financial crisis that followed it. And then, also, by the way, almost always have governments substitute public borrowing for private borrowing when private markets close, and then continue the debt bubble on public balance sheets as opposed to private balance sheets. So this 8%, 7 to 8% unemployment, 2-ish% economic growth is also sort of a factor is also something that history has seen before, is consistent with the level of debt we have in our economy, and I think means that that's sort of a reasonable prognosis for kind of where we are today and what we're likely to see for the balance of this recovery. There's another analysis down here which gets to the same point, which is that the recovery of GDP and household consumption from economic crises that are accompanied by high levels of debt in the economy versus low levels of debt in the economy way underperform. So it's the same sort of thing. So there's a lot of history that shows that the future is now. This is the recovery, 2% growth, 7 to 8% unemployment. This is what we're going to have to live with. We have to learn to adapt to these set of circumstances. Okay, so one of the results of that is that this is the first time in modern economic history in which our economy did not get back to trend growth and we perhaps permanently lost output. So if you look over here, what you can see is the dark red line is the real performance, is actual GDP, and the pink line is trend. And you can see each time we've had a boom or a bust, we've gotten back to basically a GDP trend line this is 60 years of data. You can see up here, it's the first time that we haven't done that in 60 years. And that's about a loss of about $1 trillion of potential output so far that we haven't gotten back to. And by the way, if we grow 1% less for 10 years, that's another roughly $1 trillion. So we're in the process of underperforming our economic potential by about $1 to $2 trillion over the course of a 10-year time period. That's really important because the slack that's in the economy that's associated with that is one of the reasons why inflation is not likely to be an issue anytime soon. Okay, so where we are today, lots of people are saying, hey, this is great. You know, you guys who say it's 2% growth, 7 to 8% unemployment, you don't know what you're talking about. Real estate market's coming back, the consumer's rocking, you know, this economy is now going to start growing. 3 to 4% growth rate. So when was the last time the U.S. economy grew at a number that started with a 3? Anybody here know? 1990s, right? No, it started with a 4, 1990s, right? So, and the average recovery, the average growth in the last recovery was 2.7%. So all I'm saying is 2% looks like more likely rather than 2.7%. The problem is two things. One is people who are sort of really excited about kind of the nature of this recovery and the kind of now it's really getting ready to get a boost between it aren't really adding it all up. They aren't really looking at, well, this sector's growing by that much, that's percent of GDP, you add that, that's kind of this much growth, this sector's now declining, that's percent of GDP, put that much growth into it, and you add it all up, and it ends up back about 2%. Why? Because there are two major sectors that are in decline while that have been propelling this recovery to date, and that the two major sectors that are now in recovery are not enough to overwhelm the decline. The two major sectors that are in decline right now are manufacturing and exports, which have been carried us. You can see right here, new manufacturing orders are slowing significantly. The dollar is strengthening, and our export partners are weakening. So manufacturing exports, we got to, most people don't understand it, we got the dollar down to its lowest level on a trade-weighted basis since the 1930s. And exports as a percent of U.S. economic output up to the highest level we've seen in a very, very long time in the first part of this recovery. So that manufacturing exports was driving a meaningful part of the recovery. The other thing was government spending. Meaningful amount of government spending doing what it's supposed to do, which is stimulate the economy. But now, as all of you know, we're in a fiscal contractionary period where there's something called more like fiscal drag rather than fiscal expansion coming from government spending and manufacturing slowing. If you look at what's picking up some of the slack now is, you got consumer spending, but consumer spending as a percent of GDP, this number up here is still under 2%. And the real estate sector, which is now starting to pick up, is still way below its average of 0.9% contribution to GDP since 1970. And is not picking up enough, contributing about 0.4% to GDP. So these things are helping us, but they're not big enough to offset the declines in manufacturing and in fiscal spending to create anything more than, to do anything more than replace those other factors as they kick into place. Which is good, because if we didn't have that, if we hadn't had the government spending in the export markets to give us the time to fix the problems in the household sector and get the real estate contributing again, we'd be in much worse shape now, because you can't continue to borrow and spend money at the government level indefinitely. And of course, without U.S. economy growing, our export partners aren't going to be able to grow. Our partners who export to us aren't going to be able to grow indefinitely either, right? The other major thing to understand here is that at 2% economic growth, you generate about 150,000 jobs a month, which is almost exactly what we have to absorb in order to bring new entrants in the workforce. It means you make almost no change in unemployment. And since consumption is 70% of GDP, and the employment markets are huge, not the only, housing too, but are huge determinants of the nature of consumer spending, it's highly unlikely we're going to get to very high levels of consumption absent meaningful increases in reductions in unemployment, which require much higher growth in GDP than we have today. This number shows you how long it takes to get back to 5% unemployment at various trajectories for GDP growth. Now I'm saying, the historical evidence and recent performance suggests 2% GDP growth. Let's say I'm wrong. Let's say it's 2.5% GDP growth, which is just slightly less than the GDP growth we averaged in the last boom. You don't get back to 5% unemployment until out past 2024. That's just math. Right? So the notion that, and that's just math, that's not opinion, all you got to do is just do the math on this, right? So the notion that the economy is going to drive these gains in unemployment and income, they're going to generate the consumption, they're going to generate the economic growth, so you get us to 2.5%, seems to me to be unlikely. Talk a little bit about this. So what are the investment implications of this? So a couple of things. One is the world is challenged for growth right now. And so you need, upper left here, we show the potential growth rates in the advanced economies, the U.S., Eurozone, and the developing economies. I do think you have to diversify yourself geographically in order to capture growth. You need to have a global business and be able to find opportunities to invest in growing parts of the world in order to outperform. Secondly, upper right, this is people talking my own book, I suppose, but I have my book because I like it. The tech part of the GDP grows at somewhere between 1.5 and 2 times the rest of the GDP. So investing in technology companies, investing in sectors of the economy, particularly technology, but others that can grow very rapidly, is something to think about. On the lower left here is the correlation of individual stocks in the S&P 500 to the S&P 500 itself. And what you can see is we're in an increasingly correlated world in which 60 to 70% correlation of the individual stocks to the index is the world we live in, as opposed to the 1950 to 2010 average, which was 17%, which means, in my view, it's very, very hard if you're a mutual fund manager to outperform your index because the markets overwhelm the individual stocks. So it's very hard to be an individual stock picker and outperform the index. So picking very carefully is really, really important. And then the other one is I just threw in for kind of academic interest. I came across this today, it just really interested me. So I just thought I'd show it to you guys. This is something called the red line here is something called the MO ratio, which demographers think is a very powerful predictor. And it's the ratio of people who are 40 to 49 years old in the prime part of their working lives to people who are 60 to 69 years old who are historically retired. So it's basically, the higher that is, the more people you have working relative to the recent retirees, and the lower it is, the more people you have retired. And just as I know tomorrow I'm going to be one day older than I am today, you can actually predict this MO ratio. We know what it's going to be, right? And so you can see that as we all know, we're having an aging society. If you superimpose on that, going back to the 1950s, the S&P, the PE ratio in, I think it's the S&P 500, what you can see is they're very tightly correlated, which is kind of very interesting. So in a period where people are saving, PEs go up, and when they're dis-saving as a result of retirement, PEs go down. So there's also going to be pressure, I think, demographic pressure in coming decades on PEs. So this, I think, places another meaningful priority for finding companies that you can invest in. So how do you invest in this set of circumstances? My view is you focus on growing parts of the global economy, both geographically and by industrial sector, and you take control of them so you can determine the outcome rather than simply being a stock picker and letting the markets overwhelm the outcome. So to me, that is what I do for a living, which is technology private equity, which is you focus on technology, you do it globally, and you take control of the businesses so you can determine the outcome rather than having the markets overwhelm what you do. And that's how I think about kind of what I do and why kind of I do it. I'm done. I got 3 minutes for questions. Who do I give this to? Sir. Oh, now the reporter has to answer a question. Has to ask a question here.
About the correlation between consumer spending and the performance of technology investments, particularly kind of like in this macroeconomic kind of like going forward.
So consumer spending and the correlation with technology investments. That's a really interesting question. That's sort of there are kind of several leaps. The one good thing about technology consumer spending, right, is that it takes share from the rest of consumer spending. Do you know what I mean? Right? So if you look around all of us, all these devices we have, where people on fixed incomes who are buying iPads are not buying something else they used to buy, right? And so you're taking a lot of share. So the iPhone, when did the iPad come out? I know, was it 2009 maybe? Something like that, right? I think it's one of the most, if not the most successful consumer product in history. It came out at the depths of one of the worst recessions we've ever experienced. I mean, so that tells you kind of what you need to know, right? Which is that, so let's say consumer spending is down 4 to 5%. That's a very big deal, but we're still spending 95% of what we spent before. And if you come out with an innovative product that changes people's lives that they're willing to spend on, they will buy it. And so it's more about kind of taking share of consumer dollars than it's about being subject to the ups and downs of consumer spending generally, right? My concern about consumer spending is its huge influence on economic growth in the United States. And then it's kind of feedback loop into unemployment. Got time, I think, for one more question. Sir?
You painted a pretty ugly picture.
I don't think so. I'm an optimist.
For the U.S. And sort of return to normalcy, so what's the recipe for growth?
Well, look, just be happy you're not a European. Right? But I think 2% growth, I mean, the unhappy situation from my perspective is not 2% growth. Because, 2.7%, we thought we were pretty good at 2.7%, and now we think we're pretty lousy at 2%. What does that mean, right? I think the unhappy picture is for unemployment. I mean, the real issue is kind of how can we put these people to work who haven't had work, and oftentimes for a very long time period. That's the unhappy part of it from my perspective, the social piece of this. And I think that's something that all of us in the business community have to dedicate ourselves to, because that's we need to have this transmission belt that we call the American dream kind of work, right? But as I say, I think there are a huge amount of opportunities to be a successful investor. It goes back to this question we're taking about it. So what you want to do is, let me give you another example. In one of the greatest consumer busts that we've seen, when when consumer spending went down, people were getting rid of their credit cards. They were reducing their credit card balances, so the number of credit card transactions went down. The average balance per transaction went way down. The whole credit economy was basically down 1 or 2% overall. The debit card economy took off because people were used to the convenience of plastic. The infrastructure was out there. People still had to go to the stores even though they weren't using credit cards and buy food and drugs and things for their families. And so if you were smart enough to figure out, I want to be in the debit card economy in that world, you could still make a lot of money doing it. So that's how to think about it. It's not a bleak picture. It just means no longer are we in this period where for 10, 20, 30 years, the S&P 500 goes from, the Dow Jones Industrial Average goes from like 500 to 14,000. You take a little debt, you go long that for a 30-year career, and you look like a genius. You know what I mean? That's kind of, I think that kind of type of thing is over, and it's back to kind of real disciplines around picking good companies, in my view, is also having the opportunity to take control of them and have an unusual unusual influence in determining the outcome. I got to go. Thank you for having me.